There we go. Perfect. So everybody, please put your hands together for the fantastic Mark Burnett. Thank you very much.
Hi, thanks, Sarah. Hi, all. I'm going to turn on my camera very soon because it distracts me seeing my head bump around like Max Headroom on the side. So there I go. I'll turn it on when we get to Q&A. Sarah, if I get to the 10-minute mark, please wave frantically so I stop rabbiting away. So I guess the first question in terms of updates in JORC, it has been a very bumpy and long, tedious ride. I'm not part of the JORC committee. However, I am part of PERC and CRISCO. So the latest update is that the discussion document will be available end of June or July. There has been some delays with the regulators in Australia. The problem is with most of our reporting codes that we use in the West, they either have to go through a stock exchange or they need to go through some degree of legislation, be that as it may. Anyway, I'm going to be getting back to probably more basic things, more what do we all need to be reminded of as geologists. I mean, we all get really excited about the energy transition and all these new exotic mineral species that we're going to start playing with, and that is going to move us away from a dependence on a carbon-based economy. So I need to acknowledge my co-authors for this presentation. So General Manager, and then my other colleague, Justin. Now, the whole point of what I'm going to be presenting is nothing new. I mean, we're all familiar with it, but a lot of the times as I'm reviewing projects, people get really excited with what's going forward, but tend to forget some of the really basic stuff. And in the excitement to get that new project on the go, we tend to forget some things. But the first thing we need to really understand is a lot of the times we misunderstand, and thank you very much to the previous speaker for discussing this, we really misunderstand the difference between risk and uncertainty. Most of the time, what we're looking at in the geological or geosciences space is actually uncertainty. It's very difficult to quantify. We don't know because every deposit is new, every deposit is unique, every situation is unique. However, humans being what we are, we tend to default to familiar terms and language. So most people, when you talk about uncertainty, automatically translate this to risk. So risk we can actually quantify and put a mathematical number to it. But for the sake of brevity, I'll just use risk because that is what all our standard reporting codes refer to as we're going forwards. So the way that we tend to try and do this from an exploration and a mining point of view, because we are very much profit driven in the West. We don't have a command and control economy like effectively the Chinese have a modified version. Obviously, the Soviet Union did have a command and control economy where the state is subsidizing most expenditure. Now, obviously that money has to come from somewhere. And you can see what happened to the Soviet economy and the collapse of that because effectively of potentially Western economic models not being followed. Now, I know we can get into a whole discussion about economics and the pros and cons of a capitalist model, but the sad reality is if we are going to try and finance these things, you have to be cash positive or the money needs to come from somewhere. So if we go back to a standard capitalist-based model, to try and mitigate our risk or uncertainty, we tend to start looking at a whole load of very early stage models where Sarah and company tend to get involved in the discussions we've had. How does that impact on local communities? How does that impact on environments? We tend to see in the West, because we are a developed economies, we moved into quaternary or knowledge-based economies, we don't like this fact of a big hole in the ground, and we tend, while legislation has tended to push this out into other countries where they are developing economies or emerging economies, and we tend not to see the environmental impact or the social impact that mining activities tend to have. But as we start moving through what we refer to as the mining value curve, the anticipation is we start mitigating or dropping our risk or lowering it down. So we go from a whole load of potential targets, which you can see on the far left-hand side, and we move it through to a single project. Now, statistically, we can quantify this. I'm in the process of writing up a paper for the CIM conference in October, where we can try and, at least on a global scale, try and track down or put a number to this. So the numbers that start coming out in the academic research, which is available, is success rates for general projects. So something going from exploration to making money is approximately 1% of any exploration projects will turn into a mine. If you're looking to get a tier 1 project, now again, the definitions of tier 1 vary from company to company and jurisdiction to jurisdiction, you're looking at less than 0.3%, again, depending on who you're looking at. But all of these, when we're moving through a mining value curve, we run into a whole load of risks and uncertainties. And you can see some of these. I mean, people write entire PhDs on trying to tease out what can go wrong and how can we mitigate our uncertainties and our risks. Now, I'm going to be focusing on specifically some of the geological aspects, but you can see there's a whole variety of things that come into play, and a lot of these are all cross-connected. So it's very difficult for us to just say it's geology. We need to understand the impact of geology on acid mine water drainage, the impact of the minerals which are going to go to our tailings dam. How do people get involved in all of this? Because obviously people are the basis of what we're doing. People have different psychologies, there's different cultures, both a culture from a country that you come from, but as well as a corporate culture. How does that work? How does knowledge get transferred between people? Are your local communities inspired, and are they robust and resilient to changes that happen when the mine is finished? What is the impact on the environment, both from a global point of view, but also local point of view? Understanding commodity exchange rates. I mean, everything is really complicated, and it becomes very difficult to start pulling things out in individual little baskets. Except that's what I'm probably going to do, because obviously we've got to try and focus somewhere. Now, specifically when we start looking at geological risks, we can tie down to effectively the big six, of which I'm really going to try and focus and touch on the ones which have been outlined in, well, I would call it green, other people would probably call it turquoise or aqua or some other variation of not the whitish stuff down at the bottom. Now, one of the first challenges that we face, and again, this is where from a conceptual or a cognitive model, a lot of people don't understand or can conceptualize in the mental model that more drilling and more data does not guarantee that you will get a project. On more than one occasion, and I'm sure as geologists we're all very familiar with this, we just tend not to talk about it too much, is that sometimes the more you drill, the worse your project gets, because you discover that those nice continuous deposits or veins or shear zones are not as nice and continuous and are not as nice and mineralized as what you think it is. A lot of the times we potentially use inappropriate technology because we're running after keeping the costs as low as possible. So instead of drilling NQH core, we revert to RC drilling, and it may not be appropriate for that mineralization style. We tend to jump around from one place to other because, again, there's corporate, short quarteritism. Yeah, couldn't get that word right. But a CEO company is judged on its quarterly performance, and then you're not going to get money in unless you're showing good results. So, of course, there's always this drive to get into the market with the best results possible. And of course, then there's the cognitive dissonance, or that we just don't want to understand that this project that we've fallen in love with is just not performing like we need it to, and it becomes very, very difficult to just cut your ties and walk away. But this data then leads us into some of the other stuff, because any project or any estimation we do, because remember these are estimates, they're not calculations, all our models are incorrect. To steal a phrase, just some models are more correct than others. But this data and the hypotheses that we start using, we then lead into the mineral resource. Now, again, as has been previously discussed, a mineral resource must show or must demonstrate that there's potential economic viability in that resource. So not only do we need to have robust geological modeling, we need to have robust data, we need to understand the economics of the space that we're operating in. So again, we can see, from example, the platinum market, there's now been a collapse in the platinum price, partially due to changing technology, partially due to supply and demand, but now there is no demand for that. So a lot of the projects or the operations which are currently producing platinum have now got to scale back. So recent announcements is a South African mining company is going to retrench 3,900 workers because of the metal price being lower. So we, again, as geologists or geoscientific practitioners, need to understand the larger environment that we work in. It's all very well and good talking about numbers, but there's real people that will get impacted if our work has not been done correctly and robustly. Which leads us through to some of the other stuff. When we're looking at geological models, a lot of the times we now get fixated on software to do the things, and we run the numbers into a computer. The computer generates, for example, a very interesting model like you can see on the screen, and we walk away and say, well, the computer said so, this is based on the data, this must be the geology model that we have got. Now, any geologist looking at that should hopefully stand back and say, yep, maybe not. But the problem is this is what we tend to do as people because, again, there's time factors and business factors and cost factors, and you rush to get to market to try and get something out there, to try and get people or keep people interested in your model. If it is something which everybody is excited about, like graphite was, lithium is now picking up again because China's now got some new economic incentives for people to buy electrical vehicles. So again, there's going to be another demand to get to market, to get the money, to advance your project, to move it to the next stage. But it's understanding how all of these things work together and understanding how our software works. Again, as I said, with the time pressures, economic pressures, as much as we'd like to do it, we tend to get fixated. And as was mentioned yesterday, because of the cyclical nature of the minerals economy, pale, stale, boring white males like me are going to be retiring soon. There's now a knowledge gap. Where does that knowledge come from for the next generation to understand that, as is seen here, this is probably not an appropriate model for you to try and raise oodles of cash on from the stock exchange? But we also tend to forget is this other small thing, just understanding density. Are we measuring specific gravity? Or are we measuring something else? How are we going to do it? Is the methodology and technique we're using appropriate? Because at the end of the day, the density that you use is going to be a function, or as part of the function of the metal that you're going to assume you're going to be able to extract from your deposits in the ground. If you get your density wrong, it will have significant knock-on effects. Now, again, this is one of the things which we tend to ignore because doing it is a tedious and time-consuming process. Some of the more advanced techniques may cost you a bit of time, cost you a bit of money to do them, and then you have to feed it all back into it. Now, to digress is quite a salutary tale of a mining company which will remain nameless, who were noticing a discrepancy between the metal and the tonnage that they were getting in the plant versus the plan. They eventually decided to go and check the densities and discovered that the density that they planned the entire mine on was not the density that they're actually receiving. Now, the way that the company treated this was they just ignored the entire issue and just said that they have a discrepancy and it's probably due to metal being lost in the underground environment. And they continued with that story for at least another 10 years until they sold the asset to another company. We also need to understand our metallurgy. How are we going to be processing this? So getting into the study of geometallurgy, if we're starting to look at a total extraction of all potential metals and minerals from our deposits, which we would need to for a circular economy, how do we do this? Are we optimizing our processing in a way which will extract everything? Because what a lot of people tend to forget is that if you extract one metal or material, it will have a knock-on effect down the processing stream. So you're not going to be able to get a 90% or an 80% recovery of every single metal and mineral which is present in your deposit. Some of the things are not going to be extractable, or they're not going to be economically extractable, which then gets you into the situation, are you going to be looking for government grants, or are you going to then be looking at cross-subsidizing from your primary metal stream to allow you to recover some of these secondary, really critical metals and minerals, which we would need for our energy transition going forwards. Now, when you start getting into a little bit deeper in terms of this discussion, a lot of the times you'll find that some of our very specific critical and strategic metals are actually in and of themselves don't have sufficient mass, to coin a bad term, that they'll be economically viable as a standalone. So they have to be cross-subsidized somehow. And again, a salutary case in point is a lot of the metals that we need are byproducts and co-products from lead and zinc. So as soon as the zinc price or lead price goes down, you are not going to be getting all the very, very interesting seleniums and stuff coming out, which you need for your high-tech industry. So a lot of the times our boring gray bulk commodities are actually critical to what we want to do in the future. But of course, with these, not only do we have health hazards, as you can see, that come by with some of these elements that we're trying to extract, we also start seeing, as we move through our mining value chain or our project development chain, there's a whole load of variability that can occur. Now, unfortunately, I haven't been able to track down this slide. This is one of those legacy slides which comes into presentations. I'd love to know where it comes from because I think it's really good. But what you can see from this is invariably we see positive and negative variance coming around our true value. In the vast majority of projects I've ever looked at, and again, probably because of human nature and the way that the economics of mining are undertaken in the Western environment, the projects tend to be on the optimistic side. So what invariably happens is when you start doing mining and doing processing, you tend not to get what you anticipated because of the tend to be more optimistic to try and get your project through the stage gates. Now, how do we go and compensate for this? Well, one of the ways to do this is potentially to start looking at risk matrix evaluations and to start looking at trying to quantify to a certain degree what the risk is. Again, the problem with any of these risk analyses is that it's all highly subjective and it's based on experience, and there is a certain degree of pressure. For example, if you're doing this for a financial institution, the financial institution invariably has already said they want to give you the cash, and then invariably that sort of tends to translate back into a slightly more optimistic view on a project than a pessimistic view on the project. So how do we tend to try and quantify these? And this is now said firmly with my PERC, CRISCO, and UNRMS hats on. The way that the Western world at least is trying to compensate for this is having listed companies reporting through to the stockholders and potential investors using a reporting code or standard. Now, in this, the competent person or the person signing off on the report should, thanks, Eric, should in and of themselves be putting sufficient information out there for any investor to be able to understand the risks and uncertainties that they will be taking on if they decide to invest in that company. Now, currently, there are 15 countries which have signed up for CRISCO. The most recent one is PMRC, who are the Philippines. They just joined last year. There's a number of countries in the process of joining. Unfortunately, until they join, I can't really discuss which companies they are. But also to just go back in terms of, well, what are the most common codes used to report resources and reserves or our projects that we want to invest in. JORC, in a study done in 2019, had 51% of all technical reports reported according to JORC. 48% were done according to the Canadian standard, so NI 43101, which is actually the regular legislative requirement, not actually the code. And then the Canadian, the American, and SAMREC, so the South African ones, came in with less than 1%. So the conclusions of all of this, well, again, as we start moving through anything that we do, there's going to be a whole load of risks and uncertainty, which we need to try and understand and mitigate. That will cost time and money. And while our pure geological risks are overshadowed by non-technical, which we've been doing a lot of discussion around that, they will and do have significant influence on the projects that we do. And that is me concluded my talk. Thank you.
Fantastic. Thank you very, very much, Mark. Everyone, round of applause for the fantastic Mark Burnett. Absolutely brilliant. Mark, there is a question for you in the Q&A that asks you, where did you get that 1% of exploration projects turn into a mine? I would love to know the source of this, because there is a world of discussion that goes into what do these stats actually mean and where do they come from. Do you have a quick answer to that, or shall I let you go for it in the Q&A?
Oh no, I've tracked it down. There's actually 3 references. One was a study done by BHP in 2015, which apparently was in a Oz IMM conference proceeding. There was then subsequent studies by 2 Spanish authors, which I've tracked down. And then there's a third one, which I think was done based on Canadian data, which again, I'm in the process of trying to track down. So these numbers tend to get thrown around. They are documented, but for some reason, people tend not to put the references in any of the discussions that they're doing. So I've tracked down the 3 papers. As I said, for the CIM conference, I'm going to be writing a paper on risk and putting all those references in. If I can find them, I'll share them in the chat as well.
Fantastic. That is
And
amazing.
sorry, I saw your note that we're getting to 50 and I missed the first cough.
It's so good. It's all good. Brilliant. Thank you very much, Mark. Everyone, round of applause for the fabulous Mark.
Thanks all.